you've spoken a fair bit about multiples and expectations. You presented your theoretical view. Can you speak directly to the valuations or just give your views on the valuations of the FANG stocks, just being quite a topical group that people have asked about?
Yeah, so look, I put PEs in the charts. PE is actually not a good way to value these companies. I think you've got to use a discounted cash flow, which is, look, that's the theoretically right way to value any company. And it's because these companies are investing so aggressively and most of that investment goes through the income statement that depresses the E. And so the PEs are almost overstated. And if you're investing aggressively over the next 3 to 5 to 7 years, what you really need to do is build a model of where the business is going to be over 10 plus years, because that's where all the cash flows are going to be. So, look, I've also got a theory that when you start sort of investing, you're traditionally told that people overestimate the good companies and they pay too much for them, and then they underestimate the sort of the bad companies, and that was the theory behind the sort of traditional value investing. Experience has shown me that actually the opposite is often true. We tend to underestimate the great companies, and I think that's been borne out in the FANG stocks over the last in the sort of post GFC period, where they've performed, and because they performed so well, that tells you that people have actually underestimated them. So my theory for a long period has actually been that these companies are actually materially undervalued. I still think they're undervalued, even though some of them have very high headline multiples. Although the headline multiples for Facebook and Google are not high, but they are high for Amazon and Netflix. So these companies have had a good run lately. I wouldn't be surprised if they, and this is true of the whole tech space, sort of NASDAQ companies. I wouldn't be surprised if they took a while to digest some of those gains. But I am of the view that actually these companies are underestimated and undervalued long term.
Pete, we've got a couple of questions sort of more locally focused. Perhaps you can take some of these. Given what's happened to dividend yields and interest rates over the last while, what is your suggestion for people who are acquiring an income from their investments? Where should they be looking?
Okay, we're still luckily in a fairly good situation in South Africa. If you just put the international markets in context, it's almost impossible to get a yield anywhere. So the yield on government bonds offshore is zero or even negative. And if you got your money in a bank in Europe, you put in 100 euros at the beginning of the year, you can have 99 at the end of the year. A very unattractive scenario. South Africa, largely because we've got a higher inflation and interest rates, it is slightly different. So you can earn money on a low risk basis, but the yield that you're getting is much lower. So in the equity world, there are still companies that will pay dividends with a fair amount of certainty. I think it's something like British American Tobacco. So you can put together a portfolio which has some dividends. But often you're having to buy quite old state businesses in contrast to the kind of businesses that Nick is suggesting, which we certainly concur with. Then moving through into the non-equity space and moving up the curve. So in money market rates are going to come down to about 4%, we think. They always lag interest rates a little bit. One level up, we've got something, and we've had huge flows into this, our flexible income fund, where there's a running yield of about 6.8%. That might come down a little bit with interest rates lower. So in global terms, that's a hell of a nice yield, especially when inflation is sitting at 4% and might for a while go down to 3%. And then one level up, and a very interesting space from a yield point of view, is government bonds. You know, theoretically, the safest person to lend to is the government, because they can always print money. And in South Africa, our bond fund is yielding about 9.2%. So at 4%, you don't have much volatility. At the kind of 6.8%, there's a little bit of volatility. But if you're going for the bond fund, it can go up or down 2 or 3% a month. It is a little bit more volatile. So that's the kind of realm of opportunities. But you really, because, and property dividends, there's a few companies that will pay dividends, but very few, we think, in the next 6 to 12 months. So you really then have to look at your investments from an income and capital growth perspective, and perhaps rely a little bit more on capital growth. And if you're willing to take a reasonably long-term view, to be invested in businesses where you're going to get your return coming through in terms of the growth and the cash flows and profits of the business. So that's kind of a broad synopsis, but obviously everybody's individual circumstances are different, and we sit down with people and work out their income needs. And you've got to measure kind of the ability, willingness, and time horizon to take risk against all of those things.
A big part of that calculation, as you touched on, is your assumptions around or views on interest rates and inflation. What are your views for the next sort of 2 to 3 years, both in South Africa and globally?
So I think from a global perspective, interest rates have got down to almost as low as they can get. Any more cuts are kind of tinkering off a very low level. And the world can't afford for interest rates to go up for a long, long time. A lot of people have borrowed money for their houses, their own lifestyles, or their corporates at extremely low rates. And the impact, it's a lot of debt at low rates. And that's why the US can print so much money, because the actual cost of money is very low. They're only having to pay 0.5% on the money that they're printing at the moment. But and governments simply can't afford for those interest rates to go up, or companies and people will go bankrupt. That's flowed through into South Africa. We've seen some big interest rate cuts. Today, we're expecting at least another 50 basis points. And then you're probably then done in SA. That'll bring prime down to around 7.25. And from a structural point of view in South Africa, we don't think it can get a hell of a lot lower. And from an inflation point of view in South Africa, we're sitting now at a kind of a sustainable 4% type level. There are structural increases. Eskom ain't going to stop putting up prices. Rent and rental increases was always a big driver of structural inflation. That's fallen apart, and we think you're going to see leases being renewed with escalations of 4 to 5% as opposed to 7 to 8%. Inflation, because of some of the factors I talked about, you can have some very short-term deflation, but inflation will probably be sustained at around the 4 to 5% level. And interestingly, it'll be interesting to watch how that flows through into wage increases. People have got used to 8 to 10% wage increases. That's certainly a thing of the past. Michael, I don't know if you're there and you can still talk, but I'd be interested in your perspective on the same question.
I am. In fact, I'm back. But just repeat the question for me, if you don't mind, because my sound quality just slipped there.
So it's interest rates globally and locally, and local inflation.
So we currently about to embark, I think, on the biggest experiment the world has ever seen, which is probably negative interest rates. There is a change in the orthodoxy which seems to support this monetary relaxation, which is just throwing money at the problem. And we're going to test the bounds of that, of buying government bonds through central banks, and we're likely to see negative interest rates. Of course, that benefits South Africa, where we still have yield and we still have real yields. It does open up the possibility of the Reserve Bank to today maybe do more than the 50 basis points, although I would agree that that's probably what we're going to see. The problem, though, is that the world is awash in debt. And it's fine right now where we have a very sharp deflationary contraction because there's this, demand that has just disappeared. There's no real inflationary pressure. I mean, just to give you a basic example, I live on a farm. We have accommodation that we could offer to people, but we've had zero income for many months, and it's unlikely to have any accommodation. So we're going to halve our prices. So certain sectors like this is going to see massive deflation. In the long run, however, inflation is a function of how much money gets created more money chasing fewer goods. So I think in a certain time frame, and I can't give you the months, we're going to go from sharp deflation to much higher inflation, at which time banks will have to respond by raising interest rates. So short term, we're going to go into negative territory. Long term, I just cannot see how we can print trillions and trillions worth of dollars without it at some stage resulting in massive inflation. So that may be an extreme view. I'm not sure how we position ourselves in that environment, but I'm happy that's your job.
Thanks, Michael. While we've still got you on the line, Michael, and I think a question for both yourself and Nick, what are your views on cryptocurrencies at the moment and using them as a means of diversification?
So it's a dangerous one because people are very extreme about this. I'd say it's like a quasi-religion thing. I'm bullish about some of the things that these cryptocurrencies allow us to do. I think this whole thing of not having to go through intermediary, a central intermediary in some cases is very interesting. If anyone lately has made or received an international payment, and you contrast that with the ease of which you can send Bitcoin to anyone, you'll understand that there's a real use case for this thing, at least for international transfers. And so more and more business cases are being built on top of it. My advice generally to investors is just to get off zero. I think this is a speculative investment. It's got historical, very high volatility, but I think it has a chance of being very successful in 20 years' time. Satoshi himself, the creator of Bitcoin, said in 20 years' time, we're either going to see massive volumes in Bitcoin or zero. So it's an investment with a highly binary outcome, but I just think it's exciting enough in its prospects that you don't want to have zero of it in your portfolio. And I would allocate a small bit, a tiny bit, but just to get off zero. And then if you had to ask me which one, I'm less of a Bitcoin fan, slightly more of an Ethereum fan for reasons that are a little bit too technical to go into. I'd even consider an index. I'm a backer of one of the index funds in crypto. So a small allocation of that in your portfolio in these highly inflationary prospective times, I think is a good idea because the supply of these currencies is limited by formula. And it's not men or women that sit in central bank committees that just print more and more of these cryptos.